Imagine you're watching a newly hyped stock's gray market premium just climb day by day. You check your phone, and it's up 40%.
Right, the hype is building.
Exactly. And then the next morning, it's 60%. By the time the actual listing approaches, it's hitting an 80% premium. And your Telegram groups, the investing forums, they're just practically vibrating with anticipation.
Oh yeah, everybody wants in.
So take a retail investor, let's call him a Rahul, from the source article we're exploring today. So Rahul tracks this momentum perfectly. He buys in heavily on listing day at a massive 65% premium.
Which feels like a win at first.
Yeah, for about 2 weeks, he is an absolute genius. His portfolio looks incredible. He thinks he cracked the code of the market. But if you fast forward 6 months, the reality is just bleak.
Yeah.
That same stock is down 55% from the price he paid. The quarterly results completely miss the prospectus estimates. The highly visible CFO, the one who basically pitched the IPO, has quietly resigned. Right. And the promoters are sitting on a beach somewhere with their cashed out profits. Meanwhile, Rahul is just left holding the bag.
The tragedy of that scenario, it's how mechanically predictable it is. It is a recurring feature of the financial markets, systematically designed to transfer wealth from the optimistic public to the institutional insiders.
Which is exactly our mission for today's deep dive. We are looking at an article published today, April 11, 2026, called The IPO Trap: Why the House Always Wins, by Equity Decoded by Spirit.
Great piece.
Yeah, and we are going to decode the hidden mechanics of the IPO market for you. We want to unpack the structural reasons why this specific sequence happens repeatedly across, every single bull run.
And more importantly, how you can avoid becoming the designated exit liquidity for those institutional players.
Because honestly, buying into an overhyped IPO on listing day, it feels a lot like arriving at a wildly extravagant party right at the exact moment the hosts are putting on their coats, grabbing their keys, and just casually handing you the bill for the entire night.
That is a perfect analogy.
Yeah.
And, to understand why you keep getting handed that bill, we have to examine the illusion of timing. The entire trap fundamentally starts with the decision of when a company actually chooses to go public.
Right, because the underlying assumption most of us hold is that companies go public when the business has matured to some, specific operational milestone.
Yeah, we like to think that.
We think they IPO when the foundation is rock solid and they're finally ready to face public scrutiny.
But the friction there is that the investment banking world operates on a completely different metric of readiness. IPOs are almost never launched when the company's fundamentals are optimal.
Wait, really? Never?
Well, rarely.
Huh.
They are launched when the market is euphoric. We're talking about highly specific macroeconomic windows. Massive liquidity, low interest rates, and an investor sentiment that is so universally positive that buyers will just swallow exorbitant premiums without demanding rigorous due diligence.
Oh, because the valuation multiples just simply defy gravity during those windows. Like a business that might comfortably fetch 20 times its earnings in a normal sideways market, they can suddenly pitch that at 45 times, or even 200 times its earnings during a bull run frenzy.
Exactly. We all know the market is prone to hurting. But what's fascinating here is the coordination equilibrium at play.
Okay, coordination equilibrium, what do you mean by that?
So every sophisticated buyer, they actually know the multiple is fundamentally absurd. But they're playing a game of greater fool. They are all coordinating around the belief that someone else further down the line will buy it from them at an even more irrational price.
Wow. So they know it's garbage, but they buy it anyway because they know I'll buy it later.
Yep. And that equilibrium creates a moment of maximum information asymmetry. You have the most informed party in the entire equation, the promoter. They spent a decade building the business. They know every single structural flaw, every hidden liability, every slowing growth metric. And they are selling directly to the least informed party. The retail investor who just watched a 5-minute promotional video on YouTube is willingly entering a trade against an opponent who can see both hands of cards.
That's brutal. And the structural incentives driving that inflation are just completely stacked against the public. The investment bankers facilitating this, they aren't acting as neutral financial referees.
Not at all.
They earn massive fees for getting deals finalized and for showcasing huge oversubscription numbers to the press. There's zero financial incentive for a banker to walk into a boardroom and tell a company, hey, your pricing is too aggressive, you should wait.
Doing that ends the banker's career. It definitely doesn't protect the retail buyer.
Yeah.
And when the primary driver of the timing is capturing that inflated market multiple rather than, say, funding the company's actual capital expenditure, needs the fundamental priority of the business shifts.
The capital raise becomes secondary.
Right. The valuation capture becomes the only thing that matters.
It's the equivalent of a homeowner who realizes that neighborhood property values just randomly spiked by 200% because of some zoning rumor.
Oh, yeah.
So they quickly slap a fresh coat of paint over the water damage on a crumbling house, and they rush it onto the market before anyone realizes the foundation is actively sinking.
It's exactly like that. But recognizing that the house is rigging the valuation with a fresh coat of paint, that's only half the battle. If the deck is stacked from the start, we have to explore how these companies and bankers successfully convince millions of people to aggressively bid on that sinking house.
Right, how do they trick us?
The mechanism they use is simple. They swap out the numbers for narratives.
Okay, let's unpack this. Because in normal, boring markets, investors ask a very grounded mathematical question, right? What is this business actually worth based on its cash flow?
Yes.
But in a frenzy, that question dangerously shifts to, will this list at a big premium on Tuesday? And once the psychology shifts from intrinsic value to momentum speculation, all the traditional tools of valuation just get thrown out the window.
And nature abhors a vacuum. When you throw out price to earnings and price to free cash flow, the prospectus fills that void with a selective peer comparison trick.
Oh, I've seen this.
Right. An IPO will attempt to list at, let's say, 80 times its earnings. Meanwhile, perfectly healthy, profitable domestic peers in the exact same sector are trading at 35 times.
So how do they justify charging the public double the going rate?
The company will just ignore the local peers entirely. They compare themselves instead to the most generously valued, mature global players operating in loosely related high-margin sectors.
Right, and the narrative almost always relies on redefining the industry entirely through buzzwords. Like you sell shoes online, but suddenly you brand yourself as a tech-enabled logistics and lifestyle platform.
Exactly.
By just appending the word tech, you bypass the valuation constraints of a retail clothing business, and you demand the multiples of a Silicon Valley software as a service company.
And the documentation supports that illusion perfectly. An IPO prospectus will feature 40 glossy pages of TAM, total addressable market analysis.
Oh, the TAM slides.
Always. These beautiful sweeping charts showing the entire population of the Earth and projecting how much money the company will make if they capture just 5% of it.
Yeah.
But buried at the very back are merely 2 pages of actual financials.
Yeah, and financial influencers endlessly amplify those TAM slides because they are highly visual and they paint this picture of infinite frictionless possibility. Nobody goes viral on social media posting a dense thread about a company's working capital days.
Exactly, because working capital days, which is the actual measure of how long it takes a business to convert its raw inventory and services into hard cash in the bank, is boring.
It is.
It forces you to look at operational friction. TAM is pure, unadulterated imagination.
Well, I want to challenge that framing just a bit, focusing on the concept of future potential. Like, if a company really does have a massive, quantifiable, total addressable market, and they're disrupting an antiquated industry, isn't that future potential mathematically worth paying a premium for? You're investing in what the company will be in 5 years, not just the balance sheet today.
It's a fair question. But the distinction relies entirely on the timeline of reality. Narratives and TAM slides absolutely drive stock prices in the short run. Momentum can carry a story for months.
Okay.
But in the medium run, those narratives must inexorably connect to actual cash generation. A massive TAM means absolutely nothing if your underlying unit economics are fundamentally flawed and you bleed cash for every single new customer you acquire. Eventually, the market sobers up and demands to see the numbers.
And when the market finally demands to see those numbers, we trigger what the source article calls the predictable post-listing crash. So the narrative lures you in, the stock lists at a premium, the influencers take their victory laps, but the timeline of what happens next is incredibly rigid.
Yeah, the first few months post-IPO usually feel totally safe. The narrative is still fresh in the financial press, but more importantly, strict regulatory lock-in periods artificially constrain the supply of shares.
Right.
The early investors, the founders, the anchor institutions, they are legally prevented from selling their massive holdings and flooding the open market.
Then the first quarter results hit. Q1 revenue usually comes in just slightly below the incredibly optimistic, perfect scenario projections from the prospectus.
That's a little miss.
Yeah, and management jumps on the earnings call, and they just brush it off. They cite seasonal headwinds or temporary macroeconomic softening. The stock takes a minor hit, maybe dipping 15%, and retail investors often see this as a dip buying opportunity.
But then Q2 results arrive. This time, the revenue miss is far more pronounced, and the profitability metrics are really deteriorating. Crucially, this second quarter often aligns perfectly with the 6-month lock-in expiration for anchor investors and pre-IPO venture capital shareholders.
It's like being in a rare art auction. You pay an exorbitant premium because you're told the painting is one of a kind. The perceived scarcity drives the price to the moon.
Yeah.
But suddenly the doors at the back of the auction house fly open and a truckload of the exact same rare paintings are dumped onto the auction floor. The sheer volume of new supply instantly vaporizes the scarcity premium you just paid for.
If we connect this to the bigger picture, the math of venture capital accelerates that dumping process. Venture capital mandates are built on returning cash to limited partners.
Right.
So if an early-stage fund bought into this company at 10 rupees a share during a seed round 2 years ago, they're operating on a completely different psychological plane than the retail buyer. If the IPO lists at 100 rupees and then crashes 30% down to 70 rupees when the lock-in expires, the retail investor is panicking over a massive loss.
They're freaking out.
But the venture capitalist, they're still sitting on a 400 or 600% paper gain. They will aggressively offload millions of shares to lock in those returns.
And the gravity of that drop is then compounded by mean reversion. Let's look at the multiples again. You bought in at that hyped 70x earnings multiple. As the lock-ins expire and the growth narrative fractures, the broader market corrects that multiple to a perfectly reasonable 30x PE for a decent non-revolutionary business. You lose more than half your money. And the kicker is, you lose that money even if the company's actual earnings remain perfectly stable. The mathematical reality of valuation multiples simply crushes the retail buyer's conviction.
If the math is that brutal and the supply flood from insiders is that historically predictable, we have to ask why retail investors continually miss the foundational cracks in the prospectus before they hit the buy button.
Here's where it gets really interesting. It's because they are almost universally looking at the wrong numbers. They fixate on reported accounting profits and they skip the cash flow statement entirely.
It's the classic trap of accrual accounting.
Yes. Management teams can exercise an incredible amount of subjective judgment on an income statement. You can legally book $100 million in revenue because you signed a massive enterprise contract. But if the client hasn't actually paid the invoice, your bank account is bleeding $40 million in cash to service the account.
Exactly.
The income statement looks amazing, presenting a highly profitable quarter just in time for the IPO, but the business is secretly suffocating.
A glaring red flag to consistently watch for is exactly that divergence. If a company is reporting massive net profit, but simultaneously generating chronically negative operating cash flow, it usually means that receivables are piling up. They're claiming sales, but not collecting cash.
Or their inventory is bloating uncontrollably because they produce goods they actually can't sell.
Right, which leads to one of the most deceptive accounting tricks in the entire IPO playbook, the suddenly profitable illusion.
Oh, I love this one.
You have a startup that has been aggressively bleeding money, posting severe net losses for 3 or 4 consecutive years. And then, miraculously, in the exact quarter just before they file their draft prospectus, they swing to a beautiful net profit.
And the management team will go on a roadshow and claim they've finally hit an inflection moment or achieved long-awaited operating leverage.
Always the buzzwords.
Right. But when you dig past the press release and read the tiny footnotes of the financial statements, you expose the mechanical sleight of hand. They will sell a massive piece of corporate real estate and book it as a one-time gain to artificially boost the bottom line.
Or they reverse a historical bad debt provision, suddenly injecting profit onto the page without selling a single new product.
My personal favorite is when they execute extreme, unrepeatable cost-cutting measures. They completely freeze their marketing spend, halt all new hiring, and aggressively delay paying their vendors. Or they take operational expenses like developer salaries and reclassify them as investments in future intellectual property, moving the cost off the income statement and onto the balance sheet.
The defense often raised is that cutting costs right before an IPO is just a sign of good management tightening the belt, making the company lean and efficient for the public markets.
But isn't it? Shouldn't they be cutting the fat?
Well, there is a massive structural difference between achieving sustainable operational efficiency and simply starving a business of its necessary oxygen just to dress the window for a sale.
Ah, right. Because if you freeze all marketing and drastically cut R&D, your profits will absolutely jump today, but your top-line growth will completely collapse 3 quarters from now conveniently, right after the promoters have cashed out.
Exactly. None of these accounting tricks make the underlying business any fundamentally better or more durable. They exist solely to make the financials look absolutely pristine for the exact 6 to 12-month window when retail investors are reading the prospectus.
So, if the game is systematically rigged through illusionary timing, TAM narratives, lock-in dumps, and accounting manipulation, the logical next step isn't just to complain about the unfairness of the market. It's to figure out how to read their tells.
And the author provides a highly practical framework for self-defense, designed to tip the asymmetry back into your favor. This raises an important question. What should you actually look for before you buy?
Well, if you're staring at a prospectus, the first line of defense is just checking the price tag against reality. You have to ask about the multiple versus peers. What multiple are you being asked to pay, and how does it compare to boring, already public companies in the same sector?
Right. If the bankers want you to pay 3 times the valuation multiple of a similar domestic company, there better be a quantifiable mathematical reason in the unit economics, like significantly better margins or provably faster organic growth.
You cannot pay a 300% premium just for a vague story about disrupting the space.
No, you can't. And to verify that growth isn't a mirage, you must evaluate the operating cash flow. You want to see 2 to 3 years of consistently positive operating cash flow.
Period.
Period. If the business has chronically negative cash flow, it is not a self-sustaining enterprise. It is an entity that relies on constantly raising outside capital just to keep the lights on. If you buy into that, you aren't funding a business model. You are funding a storyline.
Which means doing the unglamorous work of calculating normalized profit. You have to go into those dense footnotes we talked about and strip out the noise. If you remove the exceptional items, subtract the other income, and back out the one-time real estate sales, you have to ask, is the core day-to-day operation of this business actually profitable on its own?
The final, and perhaps most revealing test, is asking, why now? Why is this specific company choosing this exact macroeconomic moment to list?
Yeah, that's the big one.
If the honest, unvarnished answer is simply because market valuations are currently sky high and liquidity is abundant, then you know exactly whose financial interests are being optimized by the timing.
But applying this framework requires overcoming a massive psychological hurdle. I mean, it is incredibly difficult to sit on the sidelines patiently doing math and reading footnotes while your friends are posting social media screenshots of their 65% listing day gains.
It's so hard.
FOMO, the fear of missing out, is a powerful cognitive drug designed to bypass your rational defenses.
The psychological difficulty is real. But understanding the math of loss avoidance provides a powerful reframe. Not losing money in a fundamentally flawed IPO compounds your wealth over time just as powerfully as making money in a good one.
That's a great point.
If you take a 50% loss on an overhyped listing, you don't just need a 50% gain to recover, you need a 100% gain on your remaining capital just to get back to the starting line.
Ouch.
Yeah. You have to remember that the market never closes. If you skip this heavily hyped, structurally rigged deal, there will always be another opportunity next week, next month, or next year.
The core value of this deep dive really comes down to discipline. By actively looking past the shiny TAM slides, by taking the time to verify the operating cash flow statements instead of the headline profit, and by recognizing the structural incentives of the promoters, the bankers, and the early investors, you have the power to step off the momentum train. You do not have to be the exit liquidity.
The harsh reality is that the house always sets the rules to favor itself. But the asymmetry only destroys your portfolio if you willingly play their specific game. When you do your own reading and refuse to pay absurd multiples for unproven narratives, you reclaim your leverage.
Well said. Thank you for taking this deep dive with us into the mechanics of the IPO trap. We hope this arms you with the analytical tools you need to cut through the hype of the next bull run. But before we close, I want to leave you with one final provocative thought to mull over.